Welcome to the 8th session of the Global Finance Conclave. I'm very excited to share the stage today with eminent speakers like Professor Chandrashekhar, Professor Sengupta, and Mr. Akash Suri. The topic of this panel discussion is credit disbursal, bad loans, and the MSMEs. This is a topic which has occupied the airwaves, a lot of media space over the past few years. We've seen several large companies, NBFCs, being unable to pay back their debt to the banks, and a consequential effect on the economy. What is the cause? What is the effect? I am not sure. We are hoping to discuss that in today's panel discussion with the experts. Several large corporates have fallen victim to this wave of bad debts. Names like Reliance Communications, SR Steel, ILFS, DHFL, some of which have gone into insolvency proceedings as well. So there are a lot of questions which several of us have about this entire topic. I'm teaching a course on the banking system to my students, and several of their questions I'm unable to answer. So hopefully today's discussion will provide me the answers, will provide some of them who are watching this discussion the answers to their doubts and to their queries. Like I mentioned, I'm joined by an eminent panel of speakers. Professor Chandrashekhar, who is a professor at the Center for Economic Studies and Planning, JNU. He needs no introduction to the people in the economics field. He is one of the foremost economists of India, works in the areas of applied macroeconomics and development economics with a focus on industry and finance. He completed his PhD in economics in 1980 from JNU and has been teaching with JNU since the early 80s itself. He was also a lecturer at the University of London and a consultant to the Ministry of Industry, and has been awarded the Malcolm Adiseshaiya Award for contributions to economics and development studies. The second speaker we have is Professor Rajeswari Sengupta, who is an assistant professor at IGIDR Mumbai. Professor Sengupta's research focuses on the fields of international finance, open economy, macroeconomics, monetary policy, banking, financial markets. Prior to being an assistant professor at IGIDR, she held research positions at IFMR in Chennai, at the World Bank, the International Monetary Fund, and the Reserve Bank of India. She was also a member of the Research Secretariat for the Bankruptcy Law Reforms Committee, which recommended the Insolvency and Bankruptcy Code for India. Our final speaker is Mr. Akash Suri, who's the Group President and National Head of Asset Reconstruction Management at Yes Bank. Mr. Suri completed his MBA from MICA, is also an INSEAD alumni. He also has certified financial analyst as well as completed his FRM. He has been with Yes Bank for more than 11 years now. He started his career with GE Capital, moved on to HSBC from there, and has been with Yes Bank for the past 11 years, rising to the level of Group President and National Head. Welcome all of you, welcome everyone. Thank you for joining us today. Before we jump right into the discussion, I would invite Professor Sengupta to make some opening remarks. She wanted to talk about the topic that we have at hand today.
Thank you so much, Keerti, and thank you to Jindal Global University for inviting me to this panel. It is a pleasure and an honor to share this space with my esteemed fellow panelists. So I have a slideshow, and I would request Keerti's help to maneuver the slides. Thank you so much. So I just want to briefly open up the panel by talking about a general story of India's credit landscape, the primary trends that have been taking place over the last one decade, and the way forward, given that we are recovering from a very big shock. Of course, I'm trying to squeeze a lot of material in about 15-20 minutes, but hopefully with this, you'll get a sense of some of the most important trends that are worth talking about. So Keerti, if you could go to the next slide. So the outline of the talk that I'll just quickly talk about is, one is the pre-pandemic credit landscape, then followed by the economic impact of the pandemic. Then I'll briefly mention some of the policy initiatives that have been announced by both the central bank, the RBI, and the government. And then what, in my opinion, are the main issues and challenges going forward. So yeah, let's go to the next slide. So, in terms of the economic conditions prior to the pandemic, now this is of course well known to everybody who's attending the panel, but it's useful to sort of revise some of these points. That before the pandemic hit India, our real GDP growth had slowed down to 4.7%. Well, I have worked on the GDP data and I know there are many problems with the GDP data, but notwithstanding those problems, we had a growth rate slowed down to 4.7%, which was quite a severe slowdown at the lowest since 2013. Unemployment by the official measure was at a 4-decade high. Private sector investment had been declining for a while and had actually become stagnant. Even consumption had been falling, which is even more worrisome. And some of the most important reasons why this was the case, and I've just highlighted a few points, there are many others. One, of course, is that we have a very big informal sector. There are a large number of MSMEs. All of these got very badly affected by a series of consecutive shocks. One is the policy shock of demonetization. Then came the default by a very large NBFC, the IL&FS. And then, of course, there was the goods and services tax, which was a shock for the informal sector. And then, other than the informal sector and the MSMEs, there was also the twin balance sheet crisis that has been happening in the economy, which has affected both the banking sector and the large private corporate sector. And we saw the manifestation of this in the form of very high levels of non-performing assets, over-leveraged firms, etc. This was the sort of the main topic of economics, so to speak, over the last several years before the pandemic hit us. And simultaneously, the policy levers were quite limited because fiscal deficit was already quite high. This is the official central government fiscal deficit of about 3.8%. If you take off balance sheet borrowing, state government fiscal deficit, it goes up to a much higher number. Monetary policy transmission has always been weak. And on top of that, we had very high risk aversion in the financial sector. And I'm going to talk a little bit about that in the subsequent slides. So let's focus more on, especially given the topic of this panel, I want to focus more on the banking and the financial sector. Also because the banking and the financial sector in general, they always take a direct hit of economic fluctuations. At the same time, they play a very critical role in any economic recovery. For example, majority of the fiscal stimulus that was announced in the last 1 year was channeled through the banking sector. Because it's very important to understand what was going on in the banking and the financial sector during this time. So we had, and I'm sure as the panel proceeds, we have more questions and discussion on this topic, but very briefly, pre-2009, we had about a 5-6 year period of very high credit boom, very high GDP growth boom, when bank credit on average was growing at a very high rate. However, this was also the period when arguably the credit standards were weak. Lot of lending was happening to big infrastructure projects. Now, these infra projects involve policy risks, and arguably banks didn't really have the experience or the specialization or the knowledge to do lending to infra projects. This was almost like an after effect of the collapse of DFIs of the 1990s and 1980s. So these infra projects involved a lot of policy risks. Many of these risks materialized after 2009. So we had a series of scams, scandals, we had policy paralysis. A lot of these problems materialized. The economy began slowing down, and it was almost like a domino effect of many cards falling at the same time. We had interest rates that were raised because inflation was very high. The rupee started depreciating sharply. So almost everything turned against the economy. And the net result was that non-performing assets started creeping up in the bank balance sheets. But for the first few years, because of several restructuring schemes, there was like an alphabet soup of restructuring schemes, which is almost like a helpline extended by the banking regulator, the RBI. Because of this, the balance sheet problems of the banks were kept hidden for a very long time. Ultimately, in 2015, the RBI did the asset quality review when the problems got exposed almost for the first time. And we got to know that at its peak, gross NPA as a share of total advances was as high as 14 to 15%. Bulk of this was in the public sector banks. And of course, primarily these were large corporate loans that were given to the infrastructure sector, etc. So let's go to the next slide. So this is a graph of the net NPAs of the banking sector as a share of advances. And we see that there was a secular decline of NPA during the credit boom period when all the banks were basically lending left, right, and center. But then from 2010 onwards, and particularly from 2015 onwards, there was a very sharp increase in NPAs of the banking sector. By any measure, this would be called a banking crisis. But because in India banks don't fail per se, we did not term this as a banking crisis. But this was a very worrisome situation for the biggest financial intermediary of the country. Let's go to the next slide. Now, what happened in the wake of this NPA crisis? And here I want to draw attention to two developments that happened simultaneously that affected credit supply as well as credit demand. Several steps were taken, and once the AQR happened and the NPAs were exposed, the RBI, the government took many steps to sort of resolve the problem. For example, many banks were put into prompt corrective action framework. Senior bank officials were investigated. There were arrests that happened. A lot of these agencies, the CBC and the CBI, did do a lot of investigations. That sort of sent a fear wave, so to speak, through the banking sector. And also the RBI directed the banks to trigger the bankruptcy law by 2017 against defaulting firms. That was also not a very easy thing to do, because if you realize that if banks are to take defaulting firms to IBC, they will also need the capital in order to write off some of the loans or take haircuts. But capital in the banking system has always been a problem in India, because more than 60% of the banks are owned by the government. So multiple things happened, as a result of which there was a very big increase in risk aversion in the banking system. The public sector banks particularly became extremely conservative and cautious in lending. Particularly, they just cut back lending to the private corporate sector. So the public sector banks were the ones who were mostly lending to the private corporate sector, giving the infra loans, etc. All of that pretty much came to a stop, came to a standstill. And the banks started withdrawing credit from the industries, from the private corporate sector. Let's go to the next slide. On the other side, of the coin of the twin balance sheet crisis, we had the private corporate sector, where the credit demand was simultaneously getting affected. So, as I was just saying, from 2009, 2010 onwards, there was a secular decline in demand. There was a CRISIL study which mentioned that capacity utilization in the private corporate sector was around 65 to 75% between 2010 and 2020. So for almost a decade, the capacity utilization did not go up. And at that level of capacity utilization, it basically makes no sense to install fresh capacity. There was also a complete decline and then a stagnation of investment projects done by the private corporate sector. So this is the graph of year-on-year growth rate of the total amount invested in total private investment projects. And you see that the secular decline from 2010, a little bit of a pickup in 2014 on the back of national elections. But then after that, there was a complete stagnation of investment growth, and in fact, a decline in growth just before the pandemic hit us. If you go to the next slide, this is a graph of the new projects announced by the private sector. Similar picture that you see that nominal value of the new projects announced, secular decline from 2010. There was a pickup in 2014, but then since then, there's been a complete stagnation of new projects announced. If you go to the next slide, so not only did we have this capacity utilization problem, there was a demand sluggishness, investment projects came to a standstill, started stagnating, and of course, when IBC came about, that basically meant that firms were effectively losing control of their own management, while IBC strengthened the creditor rights. The bankruptcy law was a short-run shock to the private corporate sector. So we started seeing that even before the IBC, there was a big deleveraging by the private corporate sector. This shows the debt to assets, the debt to equity ratio of the top 200 firms by market capitalization. These are all non-financial firms. And you see there was a decline in leverage from 2015, and particularly from 2018 onwards, there was a stagnation. Basically, this indicates that just as there was no supply of credit because of risk aversion of the banking sector, there was concomitantly no demand for credit from the private corporate sector because of low capacity utilization, sluggish demand, shocks like IBC, etc. There was actually a deleveraging by the private corporate sector. And we know big news like big companies like Reliance wanted to become zero debt companies, which is actually a big shock for the system, meaning that these companies are not even planning to expand. So they are just deleveraging. So net result of this got reflected in the credit growth by the banking sector. We see that there was a bit of an increase from 2017 onwards. This was actually banks lending to NBFCs. This was not banks lending to the private corporate sector. But from 2019, there was a very, very steep decline in the credit growth of the banking sector. And in fact, this was remarkable because in 2019, RBI did very big monetary policy easing. The policy repo rate was cut by about 135 basis points. But despite such a big monetary policy easing, we saw that there was a very big decline of credit growth of the banking sector. And of course, it did not recover when the pandemic hit us. Okay, so this sort of sums up the banking credit story of the last 10 years in a very brief nutshell. What was happening in the rest of the credit ecosystem? Well, we had, when the banks withdrew from the private corporate sector, from the industrial lending space, the NBFC stepped in a big way. But however, that also came to a halt in 2018 when ILFS defaulted on its debt. That started the NBFC crisis. This said, so this was already the banking system was reeling under the NPA crisis. The NBFC crisis further sends shockwaves to the banking system as well as the debt market. Credit spreads went up sharply for pretty much all borrowers in the bond market. As it is, we have a bond market which is very skewed towards high-rated borrowers. But after the NBFC crisis, credit spreads increased for all borrowers. Followed by, we had many other events in the financial sector. We had the DHFL crisis. We had the problem with the Yes Bank. As a result of that, there was a further worsening of risk appetite of the banks, and there was risk aversion in the overall debt market as well. So this was pretty much the story that happened before the pandemic hit us in March 2020. The net result of this decline of credit growth to the industrial sector particularly, was there has been a structural transformation of bank credit that has been underway over the last 1 decade, which is consumerization of bank credit. So if you look at the graph, this basically shows segment-wise share of bank credit. And I have to thank my dear friend Harshvardhan here because he's done spectacular work in this field. So what this graph shows you is that the top yellow, the dark yellow bar, that is the share of consumer credit in total bank loans. That went up systematically from 2010 to 2020, even before the pandemic hit us. Simultaneously, the red bar, that is the bank credit to industry, that has been going down. So it's almost like, if you look at this is just the share in the stock of bank credit. If you look at the share in the incremental bank credit, for time constraint, I don't have the graph here. It's basically almost like a mirrored image that consumer credit went up and industrial credit went down. So if you go to the next slide, these are some of the main credit trends of the last 10 years. We had an average annual growth rate of bank credit went down from 24% to 11%, so almost halving of average annual growth rate of bank credit that happened over the last 10 years. Share of industry in the bank credit went down from roughly 43% to 31%. Share of consumer loans went up from less than 20% to almost close to 30%, and that is a remarkable structural transformation. And simultaneously, the share of NBFCs has also gone up by almost thrice. So the reason I wanted to highlight the numbers is because it basically brings into focus the kind of transformation that has been happening in the bank credit landscape, with the withdrawal of public sector banks from industrial credit, from credit to private corporate sector, increase of private sector banks into retail lending, into consumer lending. It's too early to say whether this is structural or cyclical, but it's definitely something that has been happening over the last 10 years. Now let's move on to what happened in 2020. Of course, there was this huge sort of a mother of all crises. We got hit by an unprecedented pandemic. There was the lockdown that was announced without any notice that brought the country to a complete halt. This was a massive demand shock. This was also a supply shock. Many firms would eventually find it very difficult to stay afloat. NPAs could rise, but the reason I have put it in parentheses is because, as I was saying, that many large companies have actually been deleveraging before the pandemic. So this time around, the defaults may not happen so much from the large companies, but because consumer credit has been going up, the retail sector defaults could actually be much higher this time around, because we know that household debt has gone up. There was an SBI report which said that household debt has gone up from, in 2019, 2020, it was 32% of GDP. In 2020, 2021, it has gone up to 37% of GDP. That's a very big increase of household debt. So if the retail sector borrowing has gone up by a lot, which is what we are seeing from the data, it's possible that as a result of the pandemic, because of job losses and income shocks, etc., the retail sector defaults could actually go up more this time. So the NPAs could be a problem from that particular sector, primarily in the private sector banks, because they are the ones who are more exposed to the retail loans. Not so much the big firms, because they have actually been deleveraged. So the preconditions of this twin balance sheet crisis, which has increased the risk aversion of the banking sector and the financial sector, coupled with the pandemic, can overall, of course, be a tailwind a headwind as far as recovery of India from the economy, from the pandemic shock is concerned. Let's go to the next slide. So, particular impact on the financial sector of the pandemic. In FY 2021, bank credit has averaged around 6%, which is almost a 6-decade low. And of course, this has been building up for a while, as I was saying. It is not just the pandemic, but of course, during the pandemic, there was no reason for the banks to shed the risk aversion, and there was no reason for credit demand to increase either. Simultaneously, however, while bank deposits have been growing at 10% and credit at 6%, RBI has kept the system in a liquidity surplus mode, which basically, there is no rationale for that per se. As a result of this, what has happened is that banks are holding more government securities than what is mandated by their SLR requirements. So basically, this liquidity hasn't really gone into lending to the real economy. This lending hasn't really picked up 6% of credit growth. In fact, interestingly, what has happened is total bond issuance has gone up more than net bank credit. And of course, bulk of the borrowing was by government-owned entities. So it seems that government is sort of doing a bit of a crowding out, that there's a lot of lending that is happening to a lot of borrowing by government entities that's happening, and banks are also holding a lot of government securities. So the government seems to be a very big player now in the financial sector, because the big private corporate sector has sort of withdrawn, and the other entities borrowing are the retail sector. Let's go to the next slide. I'm almost done. Some of the policy initiatives, well, the Reserve Bank of India took recourse to both conventional and unconventional monetary policies. They cut interest rates, injected massive amounts of liquidity, encouraged banks to do targeted lending. Of course, not much of that really happened. There was some amount of lending by banks to NBFCs, and there was some amount of lending by banks to MSMEs because of the credit enhancement, credit guarantee schemes. But other than that, we haven't really seen a lot of fresh lending by the banks. Simultaneously, in order to help the banking sector, a moratorium on loans was announced. The Supreme Court announced that NPA recognition will be postponed. The IBC was suspended for about a year. RBI facilitated restructuring of both corporate and retail loans. And of course, as I said, credit guarantee for MSMEs. Now, the net result of all of these is that we're not going to be seeing any rise in the NPA anytime soon because of all of these measures that have been implemented. If the NPAs at all increase, it will probably increase about 1 or 2 years later, when all the moratorium, restructuring, all of these things expire. And that's when we will find out what the real situation is. It's almost like you know who's swimming naked when the high tide recedes. But right now, we will really not really get to understand what's going on. In terms of reforms, the government has also recently announced the setting up of a bad bank. We can discuss more subsequently in the panel. TFI, let's go to the next slide. Very quick analysis of some of these policies. Well, banks are already flush with liquidity. As I said, deposits are growing faster than loans. So they are just holding liquidity or investing in GSIBs. Not much of that is coming out to the real economy in the form of lending. There's a lot of risk aversion in the banking sector that hasn't gone down, combined with subdued demand for credit because capacity utilization still has not picked up. Effectiveness of bad bank, I am very skeptical about bad bank and DFI both. We can discuss more about it later on. So let's just finish up. That's my next slide is the last one. So in view of what I've just discussed, what I've just highlighted, in my mind, some of the opportunities and challenges now that we are in 2021, one is, of course, the pandemic seems to be receding, which is great news for all of us. It seems to be becoming more endemic. I don't think we are going to have any more lockdowns or shutdowns or anything like that anytime. There is a revival of pent-up consumer demand that we are seeing. Exports have been very buoyant, which is good news. Of course, that could be a temporary phenomenon again, depending upon how the global economy is doing and how soon services demand recovers. Equity market has been doing exceedingly well in India. Of course, much of that is a function of cheap global liquidity that is coming from the US, etc. As a result of which we are seeing FII investments have picked up. Again, could be a temporary phenomenon. But in terms of challenges, particularly for the financial sector, I think the structural problems of the banking sector in particular and the credit landscape remain unaddressed. And they need to be addressed as urgently as possible. Infrastructure financing continues to be a problem area. We can't have it. We can't have banks to it. Again, I said I have reservations about the DFI. We need a bond market, but the bond market continues to be underdeveloped. The unsecured retail lending, which has picked up a lot, it is worrisome. It continues to pose risks. Also because we don't have a legal resolution mechanism for unsecured retail lending. The IBC is only for large corporate sector defaults. Now, the corporate balance sheets are healthier now than they were 4 or 5 years ago because they have been deleveraging. Yet, we are not seeing any kind of revival of the capital expenditure cycle or the investment cycle, despite interest rates being very low. And that, to me, is a singularly worrisome feature of the recovery of the Indian economy, because unless private corporate investment picks up, it's not going to be possible for us to revive and sustain a high GDP growth rate for the next few years. So I'll just end with this, and then now just happy to do further discussion in the panel. Thank you.
Thank you very much, Professor Sengupta. That was a very comprehensive overview of the situation that has been developing in the banking industry, in the financial sector over the last 10 years, over the last couple of decades, not just in the banking industry, but across the entire economy. So if I may ask a few questions, and if I may start off by asking Professor Chandrashekhar, how much of the current NPA crisis, I mean, when I say current, it's not just because of the pandemic, like Professor Sengupta explained, talked about it, the issue has been building up for quite some time before the pandemic. How much of it can be attributed to poor policy making by successive governments in the past?
Yeah, I think there are two things that I think we should look at here. First, of course, is we shouldn't look at or present the problem as if it's a problem of the banking system or the public sector banking system in particular. And the reason is that we must recognize that one of the consequences of the sort of liberalization which began with the Narasimhan Committee reports, the whole idea of the Narasimhan Committee was that having special development financial institutions actually created a non-level playing field because of the fact that they could get access to either a special window of the central bank or resources from the budget of the government, and also because of the fact that there are implicit guarantees, them being publicly owned, or at least most of them being publicly owned, they were in a position to be able to borrow at relatively lower rates of interest, including from the banking system. So therefore, the argument was we should do away with what was a very elaborate development financing architecture, excepting for a set of development banks with a social mandate. So we can have a NABARD, we can have a SIDBI and so on, but we actually do not have a set of institutions whose role is essentially to close the gap for long-term finance, which tends to exist in all market economies, in particular market economies which are in the early stages of industrialization. So across the world, whether it's Brazil or whether it's China post-liberalization, development or Korea, when it industrialized, development banks have always played an extremely important role. Now, if you do away with development banking by, I suppose the principal way was to allow them to set up a commercial bank and then to reverse merge the DFI into the commercial bank so that we have an IDBI bank, but we don't have an IDBI. We have an ICICI bank, but we don't have an ICICI, etc. You end up with a situation where what you would have is you need to find some other way of financing long-term investment, but particularly capital-intensive long-term investment, not just in infrastructure, but crucially in infrastructure too. Because as you expect the private sector to step in and play a more major role in terms of investment, the sort of backing in terms of the ports, the power, the roads, the need for aviation infrastructure, telecommunications, etc., has to be provided for either by the government or by the private sector with support from the government. Now, the second aspect of the scenario which we faced particularly after 2003, when we passed the FRBM Act, was that the ability of the government to be able to finance these kinds of capital-intensive projects was undermined because, on the one hand, liberalization meant moving to a more lenient taxation structure. And second, of course, you really wanted to curb your fiscal deficit. So the idea that the government or the state, as happened in the 1980s, could borrow large amounts and spend was brought to an end. So you had a situation where the government couldn't step in and close the gap which existed in terms of providing support to the private sector through the development financial institutions or the public sector in certain cases to undertake this investment. So really, this gap had to be closed in some fashion. And the fact that you had a public banking system where the government could actually, in some sense, nudge, push, or force the banking system to undertake a certain set of activities is what I think is responsible for the public banks entering into a set of areas of lending, which involved huge maturity and liquidity mismatches. I mean, you can't take money from depositors and then try and put money into roads and ports and power generation, power distribution, etc. So that's the first thing. I think that there was a fundamental flaw in terms of the move to using the banking system as a mechanism to close the gap for long-term finance, particularly capital-intensive long-term finance. The second thing I think is that this was a period, the period of the credit boom was also a period in which we saw a huge flow of capital into the Indian economy from abroad, both in terms of coming into the equity market, but also coming in terms of private placement, in terms of bond market investments, etc. So if you look at the deposit base of the scheduled commercial banking system relative to GDP, there was a huge spike. So much so that if you look at it because banks can't sit on money. If they get money for which they're paying interest to those who put the money in, you have to actually keep the money moving. And therefore, if you look at what happened in terms of the advances of the scheduled commercial banking system relative to GDP, it used to be in the range of about 20-21% right through the 1990s. It moved from there to something like 52-55% over a short period of something like 8 years or 9 years. Now, if you have a situation where the banks are being pushed into having to suddenly increase their lending in such large measure, then obviously they have to find new areas to lend to. And the one area they went to, of course, is retail lending, where even today, I mean, the default rate is something like 2% or a little more than 2%. So we haven't seen, even though if you look at it in terms of the share of advances going to the retail lending sector, even before the decline of lending to industry, you had seen a significant increase in retail lending by the banking system. And the second, of course, is the banks thought that there was an implicit sovereign guarantee because, as I said, the state was either pushing them, nudging them, forcing them to lend to infrastructure, and therefore they went into an area where they shouldn't go. And really, a lot of those investments, which were undertaken by the private sector, possibly under the presumption that they saw this as free money, resulted, were investments which really didn't take off. They didn't deliver on the promise. And this was not only in areas where because of environmental regulations, etc., plants couldn't come into commercial operation. It occurred even in areas where they came into commercial operation. So I do think that there is a combination of a fiscal reform which does not allow the state to undertake a certain kind of investment, an end to development financing, which actually meant that the infrastructure we had created to close the gap for long-term finance disappeared. You transferred this burden because you own the large part of the banking system to the public banks. And since there are huge liquidity and maturity mismatches, you saw what happened. And therefore, you ended up with a situation where a process of growth, we're talking about 8-9% rates of growth per annum, a process of growth which rode on this credit bubble couldn't be sustained beyond a point. Once you got rid of the corporate debt restructuring mechanism as a way of hiding your bad debt and actually required recognition of bad loans for what they are. So this is the way I would like to, see the NPA problem.
Thank you very much, Professor Chandrashekhar. Mr. Akash, Professor Sengupta, if you have anything to add to Professor Chandrasekhar's answer.
But first of all, say the presentation shared by Rajeswari ji as a practitioner, right? It was an excellent summary of what we've seen over the last 10 years, and I think it's very well laid out. I think just to build on both the points made by her and Dr. Chandrasekhar, if you look at the NPL problem and we go through the chronology. So first the problem was largely on the public sector bank. Then it followed up with NBFCs and cascaded further. What has happened in the banking sector is initially the larger part of the problem was there on the project finance. While our transition from DFIs to banking and now the thought process of going back to DFI, like Rajeswari ji also shared, I am also circumspect how potent that thought process will be, and I think the need for infrastructure financing for a country like ours would continue, and I think the challenge of setting up a DFI, operationalizing it, and then giving it the wherewithal to cater to the requirement of a country is not going to be easy, and hence, whether we like it or not, the responsibility will continue to stay with the banks. The issue is going to be with regard to that, how do we actually have a balanced growth? So the point which got made that Suddenly we moved on swings from one side to another. Earlier, all the credit growth was coming from project financing, and now, say nobody wants to say fund a real estate project, but every lender in the town only wants to fund a mortgage loan. Nobody wants to fund say construction of a road, but people want to only fund say vehicle finance, and these things can't stay like that, right? So there has to be a little bit of say balanced growth. I think the good thing is that say with a little bit of consolidation which is happening in the PSU, the strength of say some of the public sector banks going forward will be better to cater, right? Because it's also a function of risk concentration. So large part of the problem earlier, say which happened, was because of the project financing, which was say we could say choice of credit, say the way sanctioning was done. So naturally at that point in time, say as a country, the equity contribution which was required to be put by the promoters, so possibly was not there. There was a little bit of gold plating. And these are issues of the past which we only have to learn from. But a very large part of the issue, say, continue to be in terms of say timely approvals, strong mechanisms of say finding resolution to the dispute, right? Because in any large say project implementation, these are issues. If that is streamlined, then the solution would be much easier. So government has done some work on it. I wouldn't say that so we've solved it fully. And I think a large number of infrastructure say companies going into bankruptcy. So one of the reasons is that while on paper they would have claims from the government or the authority, they would run out of money to fight for those claims, right? And I think as a country we just have to learn from it and fix that problem if we want to say have that sustenance. Second, I think the migration to NBFC naturally was a mix of say credit problem which got escalated because of INFS say default, which in a systemic manner froze any financing, right? And I think that sort of escalated both issue of say credit and liquidity, and I think that has put say viability of NBFCs in a little bit of say question, and that roadmap is still say at least to me is not very clear, except for those which are purely focusing on retail. But so there are inherent advantages of having say NBFCs which also say cater to capital market requirement or real estate, for example. Third pillar I would say is say looking back, there was naturally weakness on the resolution framework, right? At that point in time, say restructuring was there, but given the baggage that as a country we had with regard to success of the restructuring, there was say both say inhibition on actually supporting the restructuring, coupled with the policy framework which actually moved that any restructuring would automatically be tagged as NPA. So so that actually forced that restructuring was not that viable a mechanism. Say it's good that at least we say got the bankruptcy say framework which has its own issues, but from a longer term perspective, it's a milestone say legislation which the government has put. So having said that, while it's say I wouldn't say early days, so we've had some seasoning. If you look at the statistic in terms of the percentage of say companies which have come back say resolved from the bankruptcy say framework as compared to say number of say companies which have not say had success, that ratio is not very good. And if we juxtapose say that to say that if number of patients which go to hospital, how many come back alive, that is not a great record, right? And I think the answer stays that for every kind of company, say a straight-jacketed IBC regime is not the best, right? Because if you look at any asset-light, say company, for example, an EPC company or a service, say company like Jet, right? it is very difficult in the current NCLT IBC framework to find a resolution just because of the time that it takes to find a solution. And the longer the time, say, to keep the company going concern becomes, say, very challenging. It's good that, say, much talked about, say, pre-pack insolvency, which was so part of the discussion, is something which has been implemented for MSME. It's not had the great success, and in my view, so these are the times when we have to be slightly say forward-looking and allow it for a larger say part of the segment. So if we just break and learn from the history, say we need to have a little bit of say balanced growth. Say too much focus on the consumer say credit also will create for excesses, and the risk reward will not be right. So like I said, both monitoring of the assets from the banker side as well as the government framework in trying to get the dispute resolution is vital. And we are on the process, and we need to continue to evolve, say, having stronger and more practical methods for finding resolution. So these are what I would say are three broad buckets. Just to add, I think say other important aspect is so with regard to risk aversion, and I think say recent incidents so that we would have seen so where the defaulting say borrowers have say capability to file complaint and say put say senior bankers on top. I think these are all which are adding to risk aversion, and I think we need to so work on these to try and create a more say conducive environment.
Keerti, if I may come in.
Yes, Professor Sengupta, I was about to ask you as well.
Right. So I think, these are all excellent points, and particularly what Professor Chandrashekhar mentioned. So I completely agree that the genesis of the NPA problem was definitely, it lies with the whole collapse of the DFI structure, and the fact that public sector banks were nudged and pushed by the government to lend to infra projects and even larger projects, etc. See, what happened with the DFIs that were set up in 50s, 60s, and 70s was whenever they would issue a bond, the bonds enjoyed almost an SLR status, right? So this almost became a pseudo government entities, and this was also a time when interest rates were tightly regulated. So it was sort of easy for these DFIs to operate in that kind of an environment. But after liberalization, when we deregulated the interest rates and also the SLR status of these bonds were taken away by the government, it practically became impossible for the DFIs to survive and raise capital for lending to infra projects. And that's when, of course, as Professor Chandrashekhar mentioned, there was a merging of DFIs with ICICI, IDBI, etc. And then all of these banks were pushed into this infra lending space where neither they had the expertise nor the knowledge. And because the GDP growth, many things happened simultaneously, exports were booming, capital inflows were coming in, average GDP growth of 8 to 9%, many of these structural flaws sort of got hidden. Now, when the going is good, then nobody turns around and says what is wrong in your backyard, right? So the banks were basically pushed into this lending, and they started lending by compromising credit standards. And the assumption was that this kind of growth is going to continue for a while. Of course, that did not happen, because then everything turned after 2009-10, and the growth stories started turning. And many of these projects did not deliver. There were other licensing problem, regulation problem, etc. And of course, because there was no resolution landscape at that point of time, because IBC was not there, the RBI sort of compounded the damage by providing these kind of helplines, which helped to hide the problem. Now, hindsight, what could you have done when you don't have an IBC? And remember, the peculiarity of Indian banking sector is the coexistence of private sector banks and public sector banks. You can't have a regulation that will affect private banks and not public sector banks, right? The moment you do a forced exposure or disclosure of NPA, public sector banks will need capital. But their capital is limited to the extent the government is willing to capitalize them. And if the government doesn't want to recapitalize them, then there is no point in sort of forcing them to disclose NPAs. So it's almost like, in hindsight, what else could the RBI have done? One can also argue that. But that's in the past. And of course, the NPAs got hidden. By the time the NPAs came out, everything sort of went haywire. Now, looking at the past, I agree with what Mr. Suri said. I don't think the DFI model is very well suited to do long-term infra financing, primarily because the problems of the past haven't disappeared, right? So if you don't give the DFI a pseudo government status, if you don't give the bonds of the DFI SLR or a government bond status, how will the DFI be able to raise funds in the market? Because the bond market will not give capital to anybody who's rated less than AAA and AA. If a DFI, without a government guarantee, without a government backing, goes to the bond market to raise capital, nobody is going to touch the DFI, right? So if you're not able to raise the much needed capital, how are you going to be funding the massive infrastructure requirements? So it's basically the fundamental problem hasn't been resolved while we have set up a DFI. I don't think the banks should do it because infrastructure projects involve a huge amount of policy risk that cannot reside in an institutional balance sheet of the bank because of asset liability mismatch. That problem is never going to go away. And given the burning of the last decade, I doubt that any bank, particularly public sector bank, would even be willing to go to infrastructure project lending anymore, right? I mean, it's been a really bad 1 decade. So I don't think the banking sector is either suited to do it because of the LM mismatch or will be willing to do it given what has happened in the past. Yes, we do need specialized institutions, as Professor Chandrashekhar mentioned, but we also need a mechanism to enable them to raise money, raise capital from the market. Maybe something like a credit guarantee mechanism by the government can play an important role here, where the direct fisc of the government does not get very badly affected either. At the same time, the DFI sort of gets an implicit government guarantee, which helps it to raise money from the bond market. In absence of a credit guarantee scheme, I just don't see the DFI as starting off at all. It'll just be a non-starter. So that's my reservation about the infrastructure financing model. But yeah, this definitely needs to be resolved because I don't think there is any alternative. Of course, the larger question, of course, is developing the bond market that we have been discussing for the last 20 years. Committee after committee has been set up and only the needle has moved, not to that much. But that is the ultimate way to really do infrastructure financing when you have a vibrant and liquid and well-developed bond market. But short of that, you need a specialized institution like a DFI, but it also needs a government backing or a government guarantee. Without that, it will just not be able to raise money in the bond market. I want to mention one thing in the IBC point.
Can I come in on this? Can I just come in on this?
Please, yes.
I don't see how this would resolve the problem. Let me explain. If you take, if for example, you take the case of German industrialization, okay? What was the difference between continental banking? Because it was done by banks. There were not specialized institutions there. But what was the difference between continental banking and banking in the Anglo-Saxon world, in particular in England? The difference essentially lay in what Piero Sraffa said, where you created a structure in which there was a guarantee of liquidity provision and backing by the central bank of the Grossbanken, which then, instead of behaving like typical commercial banks who really lend short-term, were called upon as part of this structure to undertake railroadization, financing the creation of cities, going in for large infrastructural investment. So in all you take the question of the main bank system in Japan. How did the main bank system function? It essentially functioned on the basis of major support from the Bank of Japan. Now, therefore, what I'm trying to say is that you need some form of state-backed support if you really want to create, whether they be development banking institutions or commercial banks you want to use. You have to have a form of state banking where finally you're saying that the lender of last resort is not just a lender of last resort, that you are in fact saying that I'm going to provide a guarantee of liquidity if you run into a problem at any given point of time. And see what happened after the 2008 crisis. Basically, the Federal Reserve said, you bring me any rubbish paper, which was worthless, and I will give you credit at near zero interest rates on par. So what happened? Who stepped in? It's the Bank of England stepped in, the Federal Reserve stepped in, the European commercial, central banks stepped in. So in some sense, saying that, listen, it would only be a sleight of hand to say that let's take a contingent liability instead of actually providing actual funds or undertaking the expenditure ourselves. So you basically, start building up large contingent liabilities which don't show up when you're calculating the fiscal deficit. But it essentially amounts to saying that in the final analysis, like You're saying that the government is going to guarantee up to 30,600 crores the security receipts of the asset reconstruction corporation that they're setting up, which is going to resolve this 2 lakh crores worth of loans starting with 90,000. Now, what does that mean? It basically means, as far as these banks are concerned, that because there is a guarantee, they don't need to treat them immediately as bad assets, because there is a government guarantee to the extent that, of 30,600 crores. Now, these are ways of actually becoming non-transparent. It's better to actually say we give the money, or you say that we get the central bank to do a certain kind of thing. And gone are the days when you said that the central bank shouldn't be doing that, because after 2008, central banks across the world have made it very clear that when the market fails, they are the only ones who can print the money and step in. So I do think this backing is necessary. I don't want to run away from the fact that the state matters.
Yeah, so my point is that without a state-backed guarantee, the DFI will be a non-starter, because it by itself will not be able to raise funding, right? Now the question is whether the government should do it.
Why can't the state also provide it with resources? Why can't the central bank have, like it used to have, a special window? Why can't it create a special window to back the DFIs?
So I'm not
just
sure
to come in
go ahead.
So like I was saying, so naturally, say end of the day, the money is going to come from the people, right? And I think, say the problem of our country with the scale, right? We have to build 100 airports. We have to build, I don't know how many, say railway stations to be, say, privatized, right? The requirement is so large that we have to take a practical view on this, that how many DFIs will be required to actually cater to this. And in our say country, to create a DFI, the time which will be required, say, will be enormous. Right? And say, it's not that these risks, so the issue was also with regard to portion, say, control. So banks shouldn't be allowed to put disproportionate amount of money into, say, something which has, say, differentiated risk. And if the portion control is there, then the mechanism to say, strengthen the credit are there. So, for example, say we saw problem on the road projects where if there was delay of land, say under earlier concession, that was one of the larger say reasons for the project, say, getting into trouble. With HAM model coming in, say government took a call to try and say that how do we de-risk the project. Right? There are also clauses in the concession to ensure that if for whatever reason, because government is a stakeholder, if the project goes in trouble, there has to be a termination value. The problem of the past was that how many years or months will it take for the termination value to actually come in. So given the scale and size of our, say, country, I think, so from a longer term perspective, to set up a DFI and give it all that is required is good. But the problem of short term is to still find a way to fund this credit in a sensible, say, manner, and we look in the past and try and see how do we deal with this.
Mr. Suri, how much of the funding of infrastructure was done by the private banks in this country? Basically, finally, we're going to ask the question, how much do you have to give the private sector in order to get the private sector to enter infrastructure? Okay. There are some areas where they might be more than willing, like maybe telecommunications, but even there, given the shakeout, we know that a lot of them actually had to exit at the cost of the banks. So we are in a situation where you're pursuing a strategy where what you call de-risking is actually providing huge support to the private sector to attract it to come into these areas. In which case, I would say, finally, the money, I think it would be too general to say the money belongs to the people. The money is not distributed equally among the people. We don't even have a decent wealth tax or an estate scheme. We don't have an inheritance tax. There's so much money which can be mobilized out of the large surpluses which the billionaires of this country are accumulating. So the government can tax and spend. The government can actually get the central bank to open a special window. The government can actually provide to the development financial institution not just a guarantee, but provide seed capital of a kind and an implicit guarantee of the bonds it issues, which actually allows it to mobilize funds. This was done even with the earlier financial institution. So, I think you're too optimistic to say that even if you get a bit strict, the private sector would be willing to take the money and invest in these areas. The reason they rushed into investing in the areas is because they were getting all what they were getting from the bank.
So my only point in say belief is that if the performance and say value of the contract, and if we find ways to say enhance say fundamentally the quality of the credit, right, and which is where government plays a very important role. I think every sector would know, say private sector naturally is in the business of trying to say make money for their say shareholders. If they do believe that the projects are reasonably de-risk and the risk reward fits in right, they would say support it. It's a say private sector from that perspective is not a very long list.
Let me give you one example. Let us take Kingfisher Airlines. It went in through more than one restructuring. The restructuring involved reducing interest rates. The restructuring involved changing the time period over which repayment happened. The restructuring involved converting debt into equity. Finally, the banks were holding this paper, which was completely worthless. And then it was more than one restructuring round. Now, as far as I'm concerned, that the government went far too much in terms of trying to incentivize this enterprise, and yet it failed. So,
So here, I think I would agree with Professor Chandrashekhar that I don't think the private sector participation in infra lending or in infra sector is going to happen anytime soon, because it's just not the right incentives that are laid out for the private sector. The private sector responds to incentives.
Not at this point.
Not the rightly designed incentive for private sector. But I think the government guarantee or some kind of government involvement is quintessential for a DFI to take off. Otherwise, but we have not heard any discussion of that extent. So
I need to bring this discussion to a pause, to a stop, because it is so exciting. I'm actually getting messages from the audience also. They have questions and they're loving the discussion, but we have to move on to the next topic and the audience questions. So in the presentation that Professor Sengupta made, and in both Mr. Suri's and Professor Chandrashekhar's responses to my first question, all of the panelists had mentioned that a large part of the deleveraging and initially lending and later deleveraging, the lending happened at the direction of the government, more or less, where directed lending or mandated lending from the government to the industry. So there are two questions actually from two different audience members. The first one asks that if the withdrawal of government from the banking sector will help. And the second audience member asks, should India allow banks to fail? Will it make way for prudent economic policy, given that if no banks are come to know that they will not be bailed out by the government or by the regulator at a constant basis, they will be more lending on a more prudent basis. So since these two questions appeared connected, I thought I'll ask them together. Should one, the government withdraw from the banking sector? And two, should India allow the banks which are not performing well, should it allow them to fail? Anybody can.
Well, let me say, this is a set of questions which is slightly different from just discussing where the banking system is today because of the NPAs, etc. This is asking a larger question of, listen, do we want state ownership in banking? Okay, and it depends. That in essence, what you're saying is that we do know, after all, state ownership, other than for the State Bank of India, which was created by the nationalization of the Imperial Bank, we know that till 1969, large part of the banking sector in India was privately owned. Okay, and the reasons a number of committees, including the Dutt Committee, etc., gave for actually this being problematic was because of the fact that you had a situation where the own equity put in by the promoters into the banks were very small. Much of the money which they had was depositors' money. And this depositors' money was being directed largely to the industrial sector. 2% went to agriculture in the mid-1960s. And you had a situation where directors on the board of these banks actually enterprises in which they had a direct or indirect interest receive a significant share of the money is what that committee report, for example, identified. And therefore, you said that you needed public ownership. Okay. So the point is, I would like to turn around the question the other way. If you're actually going to create private ownership, how are you going to ring fence this private ownership away from some kind of mechanism in which public money would be redirected in the interests of a set of bank promoters because of the fact that they are involved, in multiple areas. And as far as the second question is concerned, so my view would be that at the moment we don't really have a clear solution for the government to pull out of the banking system. It really is trying to do it in bits and pieces, but there is a larger issue of whether you would be able to sustain. Secondly, should we allow banks to fail? I mean, if you allow the problem under capitalism is the banking system matters for two reasons. First, it's the core of the payments and settlement system, and two, it's the principal credit pipe. So if you start allowing banks to fail, you'll have systemic problems. I mean, you might allow some small bank here and there to fail. Maybe if Global Trust fails, it doesn't matter. Or you can merge it with some public sector bank. But if a big public sector bank fails, that would have systemic effects. So definitely, as far as that is concerned, and the other is, as far as public ownership, my view is that we don't have a framework of what kind of a banking system will be there if we move away from this.
Before I hand over to Sengupta, Professor Chandrashekhar mentioned Global Trust Bank because just yesterday we were discussing that case study in my class yesterday. So I'll make sure that my students watch this session afterwards if they didn't.
The GTB bank became a poster child of bank failure in India. So see, I think this question, of course, has been asked in so many different forums over the last few years about government withdrawing from the banking sector. It's more theoretical than practical in India, right? I mean, we can keep discussing it as much as possible, but it's probably not going to happen in our lifetime because it's politically extremely difficult, logistically extremely difficult. I think the larger question is, of course, ownership is important, but in India, for legacy reasons, historical reasons, we have 60% of now government owning banks. It is difficult for the government to get out of it. But a bigger question, which often does not get asked in this context, is how are the banks regulated and monitored, irrespective of the ownership, right? So banking regulation of both public sector banks and private sector banks needs to get a lot more attention than what we give it today, because a lot of this conversation gets hijacked by privatization of banks. And my point here is that if you look at both private banks and public banks, there are problems left, right, and center, irrespective of the ownership. And that's perhaps because of weaknesses and problems in the banking regulation, monitoring, auditing, etc., which doesn't really ever get talked about. Also, for example, the way bank risk management is concerned, the way NPA provisioning is concerned, all banking regulation related issues. I'll give you one simple example. In India, the way we do NPA, NPA is not something that most banks in other countries actually talk about. NPA is a very India specific thing. When a particular asset turns NPA, that's when the bank will start providing for it. And the provision increases gradually with 90 DPD, 180 DPD, so on and so forth. And what happens in India is that there are this lump sum demand for capital that comes in when a lot of assets get declared as NPA. In contrast, if you had a system where banks had a priori and ex ante providing at the time of the lending, because they are doing some kind of a credit appraisal, they have credit rating, at the time of the lending, they're providing for the loan itself, so that as and when the loan is defaulting, if it defaults, maybe you have to provide a little bit more. If it remains a standard asset, you can write back some of the capital that you have provided. So then you're sort of smoothing out the capital requirement throughout the cycle of the loan. But we don't have discussions of this sort because we have sort of taken it for granted that this is how the banking regulation will happen. And we only keep talking about privatization of banking. So I think one thing that definitely needs a lot of focus is fixing banking regulation so that we have banks operate more as profitable businesses, not as entities that are, it's okay to have loss-making banks forever because we'll not let banks fail. And now coming very briefly to the bank failure point, yes, failure of a bank is not the same as failure of a manufacturing company, right? It involves a promise to the depositor. It involves a huge loan book. It is a systemic risk problem. At the same time, we need a financial resolution mechanism. We had the FRDI bill that was tabled. We need some kind of a resolution authority so that if there is a bank that is having a problem, the immediate solution is not just to merge the bank with 5 other banks or 2 other banks or 1 other bank, right? merging of two bad banks or one bad, one good bank doesn't really do away with the problem. So we need some kind of a resolution framework for a bank that is not doing well, that is incurring losses, etc. And that is definitely something that needs to be brought back to the table, because we can't just have banks merging into one another as a solution of the problem.
Mr. Suri, your take on this?
I think very similar views. So I think the privatization of the bank, there is one, I wouldn't say it's a privatization, but the government naturally has said their intention with regard to IDBI Bank. So we'll see what happens, but it's theoretical, and I think it's so right now the question is that at least there was a draft which suggested whether corporate should have ownership of the bank. So views are not very clear on that as well right now. So the question is, if you have to do privatization, who's going to come say with these restrictions to have ownership of the bank? So it's very tough, and I think it would likely be the natural migration which is there, which will take care of this. And I think so like it was mentioned that the default of a bank is a very different situation and has much larger ramifications at a system level. So probably we'll need to have a separate session for these questions.
Thank you very much. I have a question for Mr. Suri. I mean, not that it's only limited to Mr. Suri, but I would like his opinion or his inputs first. Given that he's heading the asset reconstruction vertical in Yes Bank and the recent proposal by the government of India to start a bad bank, how is it going to impact the banking industry, and what needs to be done by the government to make this a success?
So I think it's a novel thought at this point in time, and I think kudos to both government and the regulator to try and give it a push. So thought there naturally is, if you look at the asset reconstruction companies, they've generally had fundamentally problem of aggregation of the debt, and I think for a large number of companies, until the creditor control is fully there, the resolution as a process is very difficult. That problem is partially being solved through IBC, but not fully. So I think that in my view, this is a calibrated strategy. So government is clear that the first leg of the loans which are proposed to be transferred are going to be those loans which have stayed largely unresolved for some time, have been fully provided for, and this platform will catalyze the process of aggregation of the debt. And once that aggregation of the debt is there, then the probability of resolution will be far better. But having said that, it seems that it is for the time being more limited purpose vehicle, supported by government guaranteed security receipts. Whether the bad bank proposed by the government will have perpetual life is something which is not clear. My own view is that this has to be a more market driven solution from a longer term perspective, and I think on those aspects the recent recommendations of the committee which are there for making modifications to the ARC are also very pertinent. So I think that is going to be far more useful in long term. But having said that, the government bad bank is likely to be a catalyst, and we'll have to closely watch how the outcomes come.
So if I can just make one small point in this context, see, there is an inherent moral hazard problem associated with creating a bad bank, especially if there is no sunset clause. So if you tell the banking sector that you can park all your junk in a separate balance sheet and forget all about it and go about lending, then what would the banking sector do? They will basically say, fine, I can just lend to whoever I want. and I don't have to worry about the losses and the NPAs because I can just park it with this other bad bank entity. So typically internationally, a bad bank or an ARC kind of a model has worked whenever it has been a one-time solution with a sunset clause, right? We need that kind of a mandate that the bad bank will exist, let's say, for a particular specific duration. And during that duration, the bad bank will end up resolving all the NPAs that it is taking on through IBC, etc. And after that, it ceases to exist. If that threat is not there on the banking sector, then I will be very, very worried about this bad bank, because all that we have done is transferred the NPAs from 20 balance sheets into one balance sheet. We haven't done anything new, anything extra. And even in terms of, there's almost like a transference of human NPAs also. Because if the bad bank is staffed by the same people or public sector banks have not been succeeding in resolving to IBC, how will it be succeed in through a bad bank by going to IBC, right? There is no difference. So I think the model of this bad bank needs to be thought a lot more. A, one-time solution. B, it has to be staffed by private people, specialized knowledge of resolution. It has to be market-driven, private capital. Otherwise, again, it will just be, just doing something for the sake of doing it. But I don't think then it will be a very meaningful form.
So I think just to add to that, so from that perspective, the proposal right now says only for the cases which are fully provided. So government has taken that into account. There is also a thought process to have two platforms. One is the platform which warehouses the loans, and the separate platform which will be the resolution platform, which is proposed to be privately held. So beyond the issues which have been highlighted, I think at a practical level, for some of the some of the specific borrowers, it could be useful because having control and consolidating debt from 10 balance sheets to one balance sheet has inherent and fundamental value, because what the only resolution framework that we have is IBC, and IBC with all their benefits, unfortunately, actually forces an exit sometimes very prematurely, right? Because there could be assets where if they are restructured and revived from a longer term perspective, the value accretion could be much higher, right? Now, theoretically, one can say that even with 20 balance sheets, restructuring could happen, but it's easier said than done. So these are the choice of the assets. I think there is thought which has been put. So these are naturally assets which have stayed there with IBC. They have not found a resolution. They have been fully provided for, and hence this is a little bit of pilot to see that whether these can be fully revived, and then we will have to build on that.
There is actually an audience question which Mr. Suri already touched upon in his answer towards the end. How are bad banks in a better position to resolve NPAs? So your comment towards the end, I think will answer that question. There is a question from one of my students, and he is asking that, okay, he says that he's read in an article about one of the possible areas of conflict, the pricing of the loan that banks want to offload to the bad bank, the value of the loan. So if there is, how will they come to an agreement? Now, given that the bad bank and public sector banks are both backed by the same principal shareholder, principal stakeholder, the question is, will private sector banks face a disadvantage in this offloading or in this process of transferring loans from their books to the book of the bad bank?
So,
can I? Oh, sorry.
Yes, sir, please. So, please, sir.
I do think, there are two ways of approaching this question. One is to say that, will this bad bank work? The other is to ask the question, why has this bad bank been set up? See, because we've had ARCs, we've got 28 of them in place. So, in essence, what's happened is, one, the government doesn't want to recapitalize because that will hit its budget. Two, the government has decided that really IBC has not only not delivered in terms of a quick resolution within a specified time frame without running into legal difficulties, etc. And as has happened in the case of Videocon and so on, there is even suspicion now about the integrity of the IBC process, about the valuation which is made of enterprises and so on. And three, you actually want to get the ARCs are not helping you. The private ARCs are not, or some in fact created by the banks themselves. Even those ARCs have not been able to ensure that you moved out of the books of banks a lot of these assets. So in essence, what the government is doing is to create something which will allow it to move these assets out into, for a 5-year period at least, into that entity. Try and make the price with which the movement takes place reasonable, because of the fact that the negotiation is going to be between those hired by the banks and the banks who are selling these bad assets. You still have your 15% skin on, you have to hold 15% of the AR. So the money is being put in by these banks to actually pay that 15% cash to themselves. And finally, you're in a situation where because of the fact that at least 30,000 crores of this is going to be backed by government guarantees, that you're really going to say that even those security receipts which are going to be in the hands of the bank, because most of the SRs are still being held by the banks which are trying to transfer, could, even during this 5-year period, possibly be treated not as bad assets. So in essence, that it's because you couldn't do the other things. You're not in a position to, or willing to recapitalize, because of the fact that the ARC system didn't work, because of the fact that the IBC also didn't deliver, that you've just thought of this idea and created this entity for which you're using bank money to actually get the bad debt out of the books of the banks. I mean, that's what it is. So I don't think we should now try to see whether this is going to work or not work and so on, because the intent of the exercise, according to me, is something completely different. Sorry,
Suri, you were saying something.
No, so I was just addressing the issue with regard to the transfer surprising. So that naturally say there is evaluation on what the value should be, and consensus between the consortium. But as per the regulatory guidelines, it naturally has to be subjected to a Swiss challenge. Right? So the process will be there, but within Swiss challenge, how we will compare like to like is a question mark, for which there is no practical answer, right? Because on one side you will have security receipts which will have government guarantee, which the private sector ARCs can't do. So, so we will have to deal with it. But say it's a very specific pilot, right, which is emerging from all the limitations that we have. So we can't have a perfect solution, unfortunately, and we will have to see where we reach from here.
Thank you very much. I mean, I have so many more questions to ask, but we're running out of time. So one final question from my end. In the overview that Professor Sengupta gave, she mentioned that the NPA problem because of COVID or because of the double whammy of it would not be primarily on the big industrial houses, big corporate houses, but might actually spread to the MSME sector or to the retail and household sector. So given that, this is what, economists are predicting, and it's, there seems to be some sort of consensus among a section of the, economic school of thought that this can really happen. Given that, this fear is there, and a larger chunk of the population will be affected by this, what can we do to remedy this or to forestall this, prevent this, or reduce the impact of this event from happening? Professor Chandrashekhar, if you have any, or Professor Sengupta, anyone, because this is such a very difficult question. Also, it's sometimes scares me thinking that this could happen, a repeat of the subprime crisis which happened in the US between India or stuff like that.
I'll just say something. Let's one is, as it stands now, what is the largest chunk of retail lending? The largest two chunks of retail lending are to housing, and that is to purchase houses, and the other is to purchase vehicles, either 4-wheelers or 2-wheelers or whatever it is. Now, if you look at that segment, In the retail segment, the only area in which default rates are very high is in educational loans. Otherwise, the average default rate in retail lending is at the moment, as I said, 2% plus, So it really is not something which is anywhere near subprime. The second is, so long as you remain within a range of, let's say, 5%, 6% even, that this is, after all, what is this notion of lending? It's a notion of being able to lend larger amounts without collateral, because the asset you're lending against becomes the collateral. So you lend for a car and the car becomes the collateral. You lend for a house, the house becomes the collateral. Okay. So then you basically therefore have some kind of idea of what should be the deposit which is put in by the borrower. You try and work out some ways of actually ensuring payment which occurs, that you have some degree of security, particularly in areas like housing and so on. You lend as the house gets being built and so on. So the way I look at it is, unless you get to a situation where default rates are so high that if you actually take back the asset which you're treating as collateral and put it into the market, which will result in a collapse in prices, which is what the subprime crisis led up to. It led up to a collapse in housing prices. I think as of now, it's really lending large sums to the corporate sector, which is the problem. And two, it definitely is going to be a problem with the MSME loans, because the MSME loans were given when? It was given at a point of time when the MSMEs weren't even functioning. You actually had lockdowns, you had, you basically thought that they will use the money to pay their workers, which of course many MSMEs did not do. So when as it was pointed out by Prof. Sengupta, that when the moratorium and so on ends, that you're possibly going to see a significant degree of default definitely, street vendor loans. I'm sure default rates on street vendor loans are going to be very large. So, but what we'll have to see is the quantity relative to the total amount of lending. Is it going to be such that this would be destabilizing or systemically a problem? The big loans which go to the big corporates, when it goes to Jayaprakash Associates or Jet or Kingfisher or Lanco Infrastech, or Leela Palace Hotels and so on, that those are things which actually are defaults of a kind, which when aggregated make a significant difference to the balance sheet of a bank, and therefore can have insolvency issues, and therefore can have systemic problems. So at the moment, I don't think that the loans which have gone to the retail sector, as I said, excepting for educational loans, because unless you fix the problem of people being able to get a decent education with the loans they get, as well as get them jobs at the end of that education, you're going to have defaults in that area. But otherwise, I'm not so scared as far as retail lending is concerned.
Mr. Sengupta, Mr. Suri, your opinion on this?
We have never had a consumer credit bust in India, right? I mean, unlike many other countries which have gone through consumer credit bust and default cycles, we haven't gone through any of such cycles. While unsecured lending to the retail sector has gone up, household debt has gone up, bank lending to consumers have gone up, it is true that the percentage still continues to be a very small part of the entire banking book compared to the lending to the large corporate loans, etc. At the same time, yes, the MSME loan has a very peculiar feature because it is 100% government guarantee, right? That was the condition under which the banks lent to the MSMEs. Now, what happens is, as and when, we don't know when the guarantee is going to be invoked. Now, when the guarantee is invoked, typically what happens is the government may just keep delaying giving the guarantee, or the government may say that there are some conditions of the guarantee that has not been met, etc., etc. So basically, as long as the guarantee is not invoked, it could be 3-4 years that the bank, even if a default has happened, the guarantee is not invoked. It's like a limbo where this is actually a liability on the government. And the liability on the sovereign is basically like a standard asset. I mean, it's not really anything that will show up as an NP on the bank's books. So we can continue in this limbo for the next 3-4 years when no MSME default will actually show up on the bank balance sheets because they have 100% government guarantee. And when the guarantee is invoked, when the banks go to the government is notorious for not paying up. Some guarantee clause will not be satisfied. Who knows what happens then, right? So it's not something that we are going to see anytime soon. Lot of restructuring has happened also in the retail sector facilitated by RBI. When the restructuring terms come to an end, depending upon how large the volume is, it's possible RBI will initiate another round of restructuring, We'll again not see defaults showing up on the bank balance sheets. So I think this kind of opacity of information will continue for a while, and will remain in the zone of thinking all is well, which is basically what happened in 2009 to 2013 period. That same thing might happen in retail, except the saving, the blessing in disguise is it's not as big a percentage of the bank loan books as it was earlier. So that is the only silver lining. But yes, I think the problems, for example, Mudra loan, it's a complete opaque world. It's a black hole. Nobody knows what's happening with Mudra loans, if defaults are happening. So like that will continue in the retail sector for a while. That's my hunch. And even if it happens, it's probably it won't be a bringing down the system kind of a thing. That won't happen. But the larger point that I would like to finish with is that what is going to happen, my fear is, as a result of the pandemic and focus on this retail lending and all of that, is many of the structural problems of the credit landscape will get hidden and they will not get addressed. And that's something that we will have to be very, very careful about, because we don't want a repeat of the last 10 years in the long term going forward, right? So either if a DFI is set up without the proper kind of terms and conditions, for example, a central bank can give emergency liquidity. It can't give continuous funding for a DFI. So like that, or a bad bank can work as a one-time solution, cannot work in perpetuity. So unless we address the structural problems of the credit landscape, the resolution landscape, banking regulation, then my fear is this crisis will sort of get wasted, and we will not come up with the meaningful reforms that we've been waiting for the last 10, 15 years.
Thank you, Professor Sengupta. Mr. Suri, closing remarks for you.
So the views are fairly similar, right? So when we look at the default probability, naturally it has both the components, which is willingness to pay and ability to pay. I think good thing is that in India, on the consumer side, I think the credit culture is fairly robust, and I think long back, some 10, 12 years back, when the bureau came, that has meaningfully arrested that problem. So I don't think that in that segment, willingness issue is there. It boils down to ability issue, and within that, naturally, justified and due support which was required, to keep some of these businesses afloat, has been given. And large part of this money naturally would have gone into operational expenditure. So that has possibly not gone for asset creation, particularly on the MSME side. MSME, I do believe, is more resilient than what we believe. And hence, they should come out of this. My only meaningful worry is what I earlier alluded to, which is that too much chase of credit only on one segment and losing focus on the balance is something which could create a little bit of systemic issue. Particularly, the risk reward will go off, right? So, more than just the default, right? The issue is also about mispricing the risk, right? The prices at which some of the credit is being given, right now, just because everybody's focus is on some of these segments. That is something that we have to be careful, because that is something which could create a systemic problem. Otherwise, this is not that large a portion of the balance sheet to have any meaningful worry.
Thank you very much, Mr. Suri. Thank you very much, professors, Mr. Suri. I have several other questions I had listed down. Especially I wanted to ask Professor Chandrashekhar about if India is moving away from a bank-based system to a market-based system. I had studied under one of your colleagues, Professor Mohanty, about all this, and it intrigues me a lot. But unfortunately, we have run out of time. I'm hoping we can host all of you for a longer discussion on our campus, and have more of this. I especially enjoyed the first part when there was a vigorous discussion on the first question. I hated to cut it short, but we had to move on from there. So thank you very much for joining us today. It was a wonderful discussion. I'm already seeing responses from our colleagues who are enjoying and liking the discussion as well. Thank you very much for joining us.